Welcome, everyone. We're going to give it about 1 to 2 minutes as people continue to trickle in, and then we will go ahead and get started. So, about 2 minutes after the hour, we'll go ahead and get started. Those of you just joining us, I'm going to give it about 1 more minute. We still have a few folks trickling in. Okay, to respect everybody's time, I'm going to go ahead and get us started. Good afternoon, everyone. Welcome to CU Collaborate's Risk-Based Member Benefit Analysis webinar. My name is Michael, but before I get started with intros and review the agenda, just a few housekeeping notes. If you have questions or comments during the presentation, please put those into the chat. Everyone is muted and your cameras are off, so we do utilize the chat. We can try to get to them throughout the presentation. However, we do have time for Q&A at the end of the session. And also this webinar is being recorded. I will send out the slide deck and the recording tomorrow morning to everyone who is registered. But before I introduce our awesome hosts, let me talk a little bit about who we are. CUCollaborate has a robust suite of products and services, including data analytics and consulting that touch field of membership expansion, low income designation, CDFI certification, attainment and retainment, mergers, branch strategy, and a whole lot more. Our data analytics also focus on performance measurement, regulatory optimization, market analysis, and a lot more. We're also experts in digital acquisition and can simplify the process for consumers and organizations to find, join, and borrow from credit unions. Our advanced software facilitates acquiring those new relationships that can assist with regulatory optimization as well. And I'm going to put a meeting link into the chat here where you can schedule time with us if you'd like to learn anything more about what we've discussed today. So let me go ahead and pop that in there. Go ahead and click on that and you can schedule time with us. Next, this slide goes a little more into depth on what we do and what we offer in our services and our main areas of expertise that I've mentioned, from growth strategy to digital acquisition. So again, I'll be sending out these slides and you can get a better idea of the scope of what CUCollaborate can do for your credit union. I also, of course, highly recommend you visit us at CUCollaborate.com for even more info. And now on to our hosts. First up, Luis Dupico, partner and chief economist. Luis has over 20 years experience researching credit unions, their historical and current call reports, and Aries files across a wide variety of topics, including financial stability, member-centric performance, asset growth drivers, capital requirements, and credit union openings, mergers, and closures. Before joining CUCollaborate, his clients included, among others, the Filene Research Institute, the National Credit Union Administration, the Credit Union National Association, which is now America's Credit Unions, Opportunity Finance Network, and other research institutions, government agencies, consulting firms, and university professors. Luis has his BA in economics and mathematics from the University of Southern Mississippi and his PhD in economics with specializations in statistical analysis and finance from Auburn University, Alabama. So it's awesome to have us with us. Also with us today is our founder and CEO, Sam Brunel, with over a decade of experience in the credit union industry. Sam is an expert in fields of membership, technology solutions, and growth strategies. His mission is to democratize finance by making credit unions more accessible to all consumers, thereby driving membership growth. In addition to his role at CUCollaborate, Sam serves as an advisor and investor at Credit Mountain. Sam holds a BA in political science, philosophy, and economics from Denison University and is passionate about solving complex problems to create meaningful change in the financial services industry. And before I hand it um, off to Sam, just a quick overview of our agenda. We'll overview mission-related measurements, financial health, impact measurement, member benefit, credit union analysis comparison, the risk-based member benefit analysis and profitability, different ways your credit union can look at that, and where benefits are the greatest. And then we'll go ahead and have a Q&A towards the end. And so I will go ahead and hand it off to Sam. It's all yours, Sam.
Awesome. Thank you. Yeah, so I'm going to start by just sort of going over mission-related measurements and why I will say but I would say the whole company at CUCollaborate thinks that they are so critical to credit unions. And ultimately, it is the reason that we love credit unions, which is that credit unions are really focused on maximizing and serving their owners. Like most organizations are set up to serve their owners and maximize the benefits to their members over time. And that next slide, Michael, is really, the difference between credit unions and banks. So I came from Callahan Associates. I used to be the head of sales and product development there. A lot of sort of KPI performance measurement, sort of strategic planning. What does it mean to be a successful credit union? And that comparison between credit unions and banks, I think, is important. Where I feel like probably everyone on this call has heard this a million times, but banks, for profit, owned by their shareholders, and therefore their KPIs and sort of like what it means to be a successful bank is pretty clearly profit maximization. It is much more complicated for credit unions where they are owned by their members, essentially their customers. So they both need to be profitable to build net worth and capital so that they can maximize their impact over time, but really as a means to give themselves the necessary resources to scale the benefits that they can provide their members to more and more people and increase that benefit they provide their members and their impact. And actually, great that Luis and I are the presenters here, because when I first met Luis, we discussed this very topic and thought, wouldn't it be amazing if we could actually get to a place where we could measure this? And now I think about 2 years later, here we are, and we have done it and have made tools to analyze it both on a individual credit union level, across credit unions, benchmark it, and help credit unions figure out how they can, sort of balance mission and margin in order to really maximize it. So like by balancing the two things, you should really be setting sort of calibrating your credit union to maximize the impact you have on your members and in the community long term. Next slide. The other thing that I think is really important is being able to measure this data for not just for yourselves, but being able to share it with external stakeholders is so important, and has been something that I feel like credit unions have not done a fantastic job of historically, from an advocacy standpoint, and really being able to quantify and measure that difference between credit unions and banks in a way that they can use for their own essentially strategic planning, but also for advocacy, for getting partners to help them, whether that's raising public deposits or doing community development or seg relationships, things like that. There are a number of different essentially sales, marketing, and advocacy uses for this data as well, beyond just strategic planning and defining what success is for your credit union. Next slide. The other thing that I want to speak to, because I think that a lot of people, I don't want to say conflate, but mix these two things together, is the difference between sort of like financial health measurements and impact and benefit measurements. Next slide. So for financial health, I mean, there are a lot of different metrics. I personally would sort of boil it down to financial capability, and it is ultimately, and I'm sure Luis correct me with my incorrect language here, but I'd be like sort of sentiment based the way most people measure it. It is generally done through surveys and about consumers' feelings of capability and sort of security rather than using actual not quantifiable, but observable financial account and monetary measurements. Not to say that financial health and wellness is not important, but it serves a different role. Next slide. Maybe supporting role. And just for everyone to be aware of sort of like some financial health measurements out there, there are the two main ones that I'm aware of, and if anyone has heard of other ones, please let me know. But yeah, survey structure. So the CFPB came up with one that is free, and they have a how to use guide out there. And when we send out these slides, I've linked the financial well-being scale links to the web page that gives you all of the directions of how to run that yourself if you are interested in doing that. Attune, which is through the Financial Health Network, it was spun out of the Financial Health Network, um, is basically like that on steroids with consulting and yeah, a layer to help you run it and understand it and do it with you, but they are ultimately similar things. And really, they are surveys to people of asking them about their feelings around their money. Next slide. And what we're really looking at more is measurements that come from like financial statistics associated with the financial institutions. Next slide. So when we're talking about risk-based member benefit, we are highlighting really the difference in pricing between in depending, we'll talk about it in different ways, but for, an individual credit union compared to the market or the average bank, credit unions as a group against the market and the average bank. And yeah, ultimately it is a very complicated but detailed way of benchmarking risk-based pricing over time. The way we have done it is a combination of different things, but gathering Aries data, so actual account level data from credit unions with their credit scores, product type, payment frequency, term, all of the data in that. And then we've also purchased external data from credit bureaus and gathered still yet more data from other providers for other financial products too, but so that we can benchmark the risk-based pricing over time as interest rate environments obviously change. Next slide. And so like I included this slide to sort of highlight this, which is, ultimately like there is a benchmark interest rate, which is sort of like the average bank interest rate. And then the blue line could either be credit unions as a whole or an individual credit union, depending on how we're measuring things. And ultimately the gap between the two lines is the positive or negative member benefit. And it is ultimately a choice for credit unions in sort of their business model and pricing and risk-based pricing in how much benefit they're going to create for different levels and how to ultimately strike the right balance between profitability and sort of net income and building retained earnings and ultimately growing your net worth so you can extend more products to more members and confer the benefit that you're able to create for members to get more people. So definitely this is not an argument to even forego profitability. Oftentimes it could even be in the credit union's best interest to have above market pricing. But really thinking about how risk-based pricing factors into the benefits that you're creating for members and striking the right balance of profitability and member benefit and doing that consciously. Next slide. I think this is really sort of another way of looking at it on an individual person level of sort of like what is the credit score, the balance, the interest rate that a person is charged, and then getting from that the difference in interest rate on the account level, and then backing into how much more money a year that person has because or benefits because they got that product from that credit union rather than the average non-credit union lender at that time period. Next slide. There are a few different measurements out there that aim to accomplish this sort of thing. One is Callahan and Associates return of the member scoring, which is really based off of call report data and does not it is I think a score basically like a ranking of essentially like efficiency in returning benefits to members. America's Credit Unions has been doing this for a long time with the publicly available data, which has been great for advocacy. I hope that everyone has seen those before. The problem is they do have gaps in data. So the biggest issue is from the publicly available data, you cannot know the risk profile of the members that a credit union serves. So you're sort of reduced to sort of assuming that everyone's serving prime borrowers, which is pretty problematic because and actually it kind of tells the opposite story of what you see in the data when you get down to the level that we do, which is on an individual account level, which is that where credit unions are both most profitable on an individual account level and create the most benefit is by ethically serving the lowest tiers of credit. So they would definitely show on call reports, they're going to show the highest or higher interest rates charged, higher delinquencies, and will, for all intents and purposes, sort of from public data, may even look sort of predatory, but actually when you get into the individual account level data, you can see that they're creating the most benefit for their members. Next slide. Oh, and actually, I think this is where I hand off to Luis. And yeah, Luis, go ahead.
Thank you for that great introduction. And what Sam has given us an introduction to the big picture. Now we're going to try to start looking at some individual examples of the sort of analysis that you could expect. And we have started collecting the data across a large number of credit unions. And we are beginning to have the equivalent of nationwide data that we're beginning to be able to report and discuss. So we'll get a sneak peek at all of that. Next slide, please. So here's then an example for one actual credit union that we computed. I have renamed it X, Y, and Z to protect their privacy. But if you go account by account and you compare their interest rate against an apples to apples benchmark that is appropriate for them, the right type of loan, the right credit score, so on and so forth, if you compute the benefit as an interest rate for every account, and then you multiply it by the size of the account, the loan, or the deposit. If you add it all up for this credit union, you would find that they are charging their members $10 million less than if those members went to a bank. And they are also paying their members $6.6 million more than if they deposited money at a bank. So you get a total. You can express this in different ways. You can create an average interest rate advantage, which is 1.92 for loans, and it's 0.65. And we can do this for as many credit unions as will share their ARIS files with us. And and you can rank how your credit union is doing. So for instance, this credit union, it turns out to be better at both things than about 60% of other credit unions. So not only are they doing better than banks, but they're actually better than more than half of other credit unions. So that might be an interesting strategic management question for you as a board or as management. Not only do you want to do better than banks, but you may want to do better than other credit unions. Next slide, please. So this is an example of the interest rates, of the interest rate advantage, the benefits that different credit unions have on their loans. And the credit union that had the largest benefits was charging interest rates that were 13% lower than banks for their type of customers, for the type of borrowers. That one credit union that has 13% looks like a huge number. They had a very large percentage of their members were borrowing on payday alternative loans. So that's why when you compare it against the very high interest rates for payday lenders, that's why the number is so large. But leaving them aside, you can see that some credit unions have very high benefits to 3.45. And there's actually a small number of credit unions that have very small benefits, or we're not going to say who they are, but our analysis implies that their interest rates are actually worse than those that banks have. You can see that value of 1.29. The median is 152, better than banks. And you could see, if we were doing an analysis for your credit union, you could see where you fit. Are you better than 85%, 95, 60%, 40%? So next slide, please. Is Michael. Yeah. And this is the same thing for benefits. And you can see how this credit union has interest rates that are 0.65 higher than banks, and how it fits compared with the rest of the credit union industry. Next slide. So we punch a lot of numbers, we compute a lot of numbers, and it's as a manager, as a board, you want to know something beyond, I have 10,000 accounts. Figuring out processing the information for 10,000 accounts is complicated, so it is convenient to develop a way to summarize that. So this chart is an example of that. It can show for your different types of loans, for different credit score ranges, what is the average interest rate that you are charging on all of those buckets. So this would be the equivalent of your price sheet for your credit union, and we can compute the same thing for banks. So next slide, please. That's the same. That's the same structure, but instead of giving you your own credit, your own interest rates, those are the interest rates that your members could get if they went to an average bank, and if they wanted that type of loan, and if they had that credit score range. So you compare those two numbers, and you can get benefits. So that's in the next slide, please. So that's the size benefits that you can see. And for this individual credit union, a sample credit union, we're not going to tell you who they are, you can see in the bottom row, when you average it across all types of loans, you can see that this credit union happen to be giving very large benefits to borrowers with the worst credit histories. And actually, it was giving negative benefits to the borrowers with the best credit histories, where in those individual borrowers actually would have been better off going to a bank. But that's the business decision that this credit union chose to make. If you have rates that are very good, you will attract more people. If you have rates that are worse than the competition, those type of borrowers will try to flee from you. Of course, borrowers do not only respond to price, they also respond to marketing outreach. They also have inertia, but this is the data through which you could analyze these sorts of decisions. And next slide, please. So this simply repeats the chart that Sam showed us earlier, and it shows for this individual credit union, you can see you might not know it might be hard to obtain, but what are your members being charged elsewhere? That's the blue line. That's the red line, actually. And then the blue line tells you what are you charging those members. And where you see that the blue line, your own rates are lower, you're providing a benefit. And this credit union happens to be focused heavily on borrowers with weak credit histories. It is equivalent to banks for credit unions with better credit, for instance, between 770 and 799 credit scores, and actually for the borrowers with the best credit histories, this credit union is not making a large outreach effort. Next slide, please. So that's one way to slice the data. There are 300 ways to do it. And what we're trying to do here is give you a quick overview of some of the many ways that we could develop reports for your credit union or for your board or for your management. Next slide, please. So you could slice things across different types of loans and deposits. And that simply shows you, for instance, in the middle pie chart, you can see that a lot of loans are in the form of used autos. But if you actually, that's the dollar amount of loans, but because this credit union offers better or worse benefits for different types of loans, it turns out that most of the benefits are going to borrowers for used auto loans. And that's a decision that as a credit union, as a management team, you have to make. How do I want to allocate the benefits that I provide? And you actually can see, for instance, that this credit union offers a lot of junior mortgages, but it actually provides negative benefits. Their interest rates are worse than at banks. So their share of the benefits in the pie all the way to the right is zero. There is no orange triangle. So what do you want to do as a credit union management team? How do you want to allocate the benefits? Do you want to allocate benefits pro rata across your different types of members, or are you happy with focusing on one subset of members over another? Next slide, please. This chart, that's the same thing at the deposit side. And for this credit union, you can see that most accounts are regular shares. That's the pie chart to the left is for number of accounts. There are lots of regular accounts that have very little money. So in the middle pie chart, you can see it by dollar amount, and regular shares are a smaller fraction of total deposits in this credit union. But since in this credit union, they actually offer rates that are worse than at banks, all of those depositors, all of those members that have regular accounts are not receiving a benefit. The benefit in this credit union is going towards depositors that are using shared certificates or that are using money market accounts. And this might be a decision that you're comfortable with, or faced with this data, it might be a decision that you want to re-examine. Next slide, please. So you can also slice and dice the data across account sizes. So let's look at the next slide. And this basically slices things across loan sizes. And you can see that the green lines, that's the distribution of loans by the number of loans. So there's a lot of small size loans that don't have, they don't have a large balance. So there is not a lot of money there. All the way to the right, you have the opposite situation. You have a small number of loans that are very large. And you can also see where did the benefits go. And one might think that you might want to tailor your benefits towards smaller borrowers to be more pro-social, or you might want to spread the benefits evenly so that you service all of your members well. If we could go back to the previous slide for half a second. And in this one, you actually can see that the larger loans account for a large amount of the total balance, but benefits account for a far smaller fraction. So this credit union is actually targeting its benefits towards loans that are of a medium size. Next slide, please. Same thing for deposits, and we can skip that one. We can do it across credit score ranges. So next slide, please. And again, here you can see what's the distribution of your number of loans, of the dollar amount of loans, and of your deposits for one individual credit union. And you might see that most of your borrowers are in the middle. You have a very small number of borrowers with very poor credit, and a relatively small number of borrowers with very good credit. You might want to, and we will do this later, you might want to see not only where you are, but you might also want to compare against other credit unions nationwide or other credit unions in your area or credit unions with a similar type of membership to yours. And next slide, please. So we can also present benefits across income levels, across race, across priority areas. So let's see some examples. So this is actual data computed across all our credit unions that have given us data. We have computed what share of loans is going to census block groups, small geographic areas, where the median family income is under 50,000, and then between 50,000 and 100,000, between 100,000 to 100,000, and for census block groups that are very wealthy. And there you can see the typical credit union is servicing how the loans and benefits of a typical credit union are distributed. The average, the median family income in the United States is between 60 and 70,000 right now. So there's a minority of census block groups that are under 50,000. The typical census block group is in the 50,000 to 100,000. So these numbers tell that story. You could also see if the distribution of benefits here is very similar to the distribution of loans. If you could find, theoretically for an individual credit union, that a lot of loans are being made to a particular geographic area, but benefits are not flowing, or vice versa. So that's interesting data that you would want to analyze for your own credit union. Next slide, please. You can do the same thing for race. We are able to estimate the race for your membership based on names, first name, last name, and location, and publicly available data about the likelihood that the various names in various locations will be used by different race and ethnicities. And using that, you can develop a high quality estimate of how your loans are distributed, how your deposits are distributed, and also how you might compare against credit unions nationwide, against the overall population of the United States, or against other credit unions in your area. Next slide, please. Other things that you can do is you could see how your benefits or your loans are distributed across various areas, like rural versus urban, high poverty areas, persistent poverty counties, opportunity zones, various categories and classifications that are provided by various government entities. Next slide, please. So we have started collecting this data. We're very excited about all the data that we are collecting. 3 years ago, this was just a dream that Sam and I had, talking late at night, and we thought it would be great to be able to do it. We've started being able to collect the data for individual credit unions, and we're beginning to analyze the data across all credit unions to see if there are nationwide patterns that are relevant. So let's start doing that. And here is some preliminary data that we have for instance, all new car loans, all used car loans, what interest rate, what's the benefit on average that our participating credit unions are providing to their members. And you can see the different values. Some are quite nice and positive. The average is 1.93 across all loans. The value varies across categories. For instance, for payday alternative loans, we are using a nationwide benchmark of 400% based on calculations that are reputable and that are arrived at by many outside analysts, because credit unions are charging rates between 18 and in the low 20s for those loans. The benefits on these particular loans get computed at a very high number. We could change that benchmark and to yield a smaller benefit, but we think that this is a good way to do it. The more interesting part is that there are some loan types in which we find negative benefits. When we look at the bank data, we find that for some loan types, on average, credit unions are charging higher rates than banks. And that's a decision that has been explicitly or implicitly being made by credit unions throughout the country. And armed with this data, they have to decide whether they want to reassess how they distribute their benefits across loan classes. And you can see how they get distributed in percentages, so on and so forth. Next slide, please. So other ways to show how the data is distributed. This chart shows you across all our participating credit unions how many benefits are going towards borrowers with different credit scores. And the results are not surprising, but we now have actual data to be able to discuss things. Most borrowers have middle of the way credit scores, and so most of the benefits are going there. This is the nationwide data. Next slide, please. This is an example of the nationwide data. Instead of using millions of dollars, we're using a percentage distribution, and we are comparing against one individual credit union. If you were this credit union, you would look at it and you could conclude, oh, our distribution of benefits is lopsided towards borrowers with weaker credit, which might mean that this fits into your prosocial mission, or it might simply also reflect that your membership has lower credit scores than the average population. But this is a way to assess how you're doing in this one consideration. Next slide, please. This slide, we've seen ones like it before, but this one simply shows the average benefit provided across credit scores nationwide by credit unions that are participating versus one individual credit union. And this credit union provides larger benefits across most credit scores ranges, but the degree to which they are higher than the rest of the industry is not consistent. For instance, there's a couple of credit score ranges where the benefits are actually lower. So as a management team, as a board, faced with this data, you might want to reassess your pricing, not necessarily that your pricing is all too high or that your pricing is all too low, but that it might need to be reassessed for specific credit score ranges. That you might, instead of saying, oh, we're going to charge 50 basis points more, 50 basis points more, you might need to be assessing more proactively what your competition is actually doing. Next slide, please. The same thing for deposits. What this chart shows is that the blue line shows how many deposits you're getting from savings, from checking, from money markets, from CDs, and how are benefits actually being allocated. And what this chart shows is that currently credit union members in our participating credit unions are receiving negligible benefits from saving accounts and checking accounts. And the overwhelming majority of benefits is being channeled into certificates of deposit. Next slide, please. And well, this is more of the same. So that we have more QA, let's skip through some of this. Next slide, and that's it. So thank you very much. And Sam, I don't know if you want to have any closing remarks before we open it for questions.
No, just curious. I'd love to get people's feedback. Definitely, Luis and I love this kind of analysis, but would love to get all the attendees' feedback on what their thoughts are and what questions they might have.
Yeah, if you have any questions, please pop them in the chat. We'd love to have a discussion. Luis, actually, I have a question to get us started, if you don't mind. Would you not worry that increasing lending towards borrowers with weaker credit would result in increased losses?
I would not worry. I would expect it. but
Okay.
simply the one has to have pricing that takes that into account. So to make a very simple example, it might be that super prime borrowers are charged 5%. They have a charge-off rates of 0.05. When you are lending to the most subprime borrowers, their default rate, their charge-off rate might be 5%. So you don't want to charge them a 5% interest rate because after you take into account all the cost of operation, you could be losing money. But if you charge 15% or if you charge 10%, that more than covers the charge-off rate. So some individual loans, you lose all the money, but in a large fraction of the loans, 95% of them, all the money gets paid back. So the extra interest that you get from the majority of high-risk borrowers that actually do pay would more than cover for the small minority that default. And this is a credit management issue that has been studied and well understood by financial practitioners for decades, if not millennia. And there are risks. Obviously, the more risk, the more losses that there are, but there are also the more rewards. And if you charge interest rates that are high enough, you can cover for that risk.
Well, would you not worry that reducing interest rates on high-risk borrowers could needlessly forego revenue?
That is true for the individual loan. But let me give you a stupid example. And let's say that you are charging people an interest rate of 100%. If you charge people an interest rate of 100%, they will say, you're a loan shark, I'm not going to borrow from you. I can go next door and they're charging me 40%. Thank you very much. So in that stupid example, if you reduce your interest rate from 100% to 35%, you could have a case in which cutting the interest rate that you charge actually could result in increased revenues. So it's basically, you have to do some trial and error, and you have to figure out the right balance. But if you find yourself in a situation where for an individual bucket of borrowers, a loan type, a credit score range, if your interest rates are far higher than everyone else's, and no one is borrowing from you, you shouldn't be surprised. You need to take into account the market information, and you need to respond to it. And if you are doing better than the market, you're going to experience high growth. If you're doing worse than the market, you're going to experience low growth or negative growth. You didn't build it, they will not come. So that is I think that's the best way to answer that question.
Awesome. Thank you very much. Were there any other questions in the chat? I know we're kind of wrapping up here. Again, this is being recorded, so you will get these in the slides, the recording and the slides tomorrow morning. But I want to give it one last chance if anybody has a question or thought or otherwise. We also love ideas. So if your credit union is working on something and you think that this might be helpful, or if you have an idea for us to improve or to add to this, we love those ideas. Hey, if there's nothing else, thank you so much for joining us today. You're welcome to schedule time with us from that meeting link that I popped into the chat. Again, keep an eye out in your inboxes tomorrow for the recording and slides. We'd also be very happy to go over any products or services you're interested in beyond what we've shown you today. But we sincerely appreciate your time and attention and wish you a great day.
Thanks, everybody.
Thank you.
Thanks.